Hey friends! Today we're tackling one of the biggest questions in investing right now. Is the S&P 500 about to crash like a dropped watermelon, or will it slowly deflate like a balloon left out overnight? It's the kind of question that keeps investors awake at night, especially when the market feels like it's floating on air. Most people think that when stocks hit all-time highs, it's time to cash out before everything implodes. They look at Tesla and Nvidia's sky-high valuations and assume the entire market is one bad earnings report away from disaster. But here's the twist. Market meltdowns aren't the end of the world. They're opportunities for disciplined investors to scoop up bargains. And hidden in this so-called bubble, there's $1 trillion tech stock trading at what I'd call Black Friday prices right now. Trust me, I've seen this play out before. I've navigated 4 major crashes since the 1980s, from Black Monday to the COVID-19 flash crash. And every single time, buying quality stocks during panic turned short-term losses into long-term gains. Stick around, because today, I'm going to show you why this isn't another dot-com bubble waiting to pop. The single chart that can help predict if bubbles are about to burst. My top pick from the Magnificent 7 tech stocks that's trading at a steep discount, and how you can position your portfolio whether we get a loud bang or a slow hiss. There's a lot to unpack here, so let's dive in. Welcome back to the Investing Iguana. I'm your host, Iggy, and here on this channel, we break down stocks, finance hacks, and wealth-building strategies so complicated topics feel like chatting with a street-smart friend. Quick credentials check for those who are new. The Investing Iguana is ranked 8th in Tiger Broker's 2024 Influential Tigers list. We've racked up over 768,000 reads and 53,000 likes across our content and have more than 300,000 watch hours on YouTube as of December 2024. I've been through more market cycles than your dad's favorite leather jacket, and today's deep dive could save your portfolio from costly mistakes. Let's roll! Let's start with some perspective by looking back at history. If you want to understand where we're headed, you first need to know where we've been. I've personally traded through 4 major stock market crashes, each with its own unique flavor of chaos. The first was Black Monday in October 1987, a day when the Dow Jones Industrial Average dropped a jaw-dropping 22.6% in one day. Imagine waking up and seeing nearly a quarter of your portfolio wiped out before lunch. It was brutal. The second major meltdown was the dot-com bubble, bursting between 2000 and 2003. During that period, tech stocks were flying high on hype rather than substance. When reality hit, the FTSE All-Share Index plummeted by over 50%. Then came the global financial crisis of 2007-2009, a collapse triggered by reckless lending and over-leveraged banks. During that bear market, I managed to reduce my losses significantly because I saw the warning signs early and adjusted my strategy accordingly. Fast forward to spring 2020, the COVID-19 flash crash sent markets spiraling downwards by nearly 37%. But here's what made all the difference. At the end of 2019, I had moved half my family fortune into cash reserves. When stocks hit rock bottom prices during that crash, I was ready to scoop up bargains like airlines selling at prices from 2 decades ago. Here's what most people miss about crashes. They aren't failures. They're opportunities disguised as chaos. Every crash creates generational buying opportunities for those who are prepared, not panicked. Think about it like this. If you're shopping for groceries and see your favorite cereal marked down by 50%, you don't panic. You stock up. The same logic applies to investing during downturns. Buy quality when others are running scared. Now that we've got crash psychology down, let's diagnose today's patient, the S&P 500, and figure out whether we're looking at an imminent bubble burst or just another Tuesday in the markets. Right now, the S&P 500 trades at an elevated price-to-earnings ratio of nearly 24 times earnings. What does that mean? Investors are paying $24 for every $1 of profit generated by companies in this index, well above its historical average of around 16 times earnings. That's like paying Gucci prices for Gap jeans. It doesn't make sense unless you believe these companies will keep growing at breakneck speed forever. But here's where things get interesting. This rally isn't being driven by every company in the index. It's concentrated among 7 mega-cap tech stocks known as the Magnificent 7. Apple, Microsoft, Tesla, Nvidia, Amazon, Meta, formerly Facebook, and Alphabet, Google. Together, these 7 companies make up nearly a third of the S&P 500's total value. Meanwhile, other parts of the market, like UK stocks in the FTSE 100, are trading at much cheaper valuations with dividend yields that blow away what US stocks are offering right now. A bubble typically bursts when 3 things collide: extreme valuations, concentrated leadership within an index or sector, and easy money drying up due to rising interest rates or tighter monetary policy from central banks like the Federal Reserve. Right now, we've got 2 out of 3. The S&P is expensive and heavily reliant on tech giants, but whether or not easy money disappears depends on what happens with interest rates over the next year or 2. Remember this: markets can stay irrational longer than you can stay solvent if you try to bet against them too early. Now let's talk about one specific stock within this Magnificent 7 group that stands out as an anomaly: Alphabet Goog, which owns Google and dominates online search advertising worldwide. Recently, Alphabet's share price dropped by nearly 18% in just 4 weeks due to fears surrounding an antitrust investigation into its business practices. As of today, Alphabet is trading at $171 per share, down from its all-time high of $200 earlier this year, and valued at roughly $2 trillion overall. With its current price-to-earnings ratio sitting around 21 times earnings and offering a small dividend yield near 0.5% annually, it looks like an incredible value play compared to other tech giants like Nvidia trading at 70 times earnings. Why did Alphabet sell off so sharply? 3 words: antitrust lawsuit fears. Regulators are concerned about Google's dominance in search advertising. But let me ask you this: do you really think Google is going anywhere? It's like worrying TikTok will kill YouTube. They're different beasts operating in different jungles entirely. Alphabet isn't just a growth stock, it's a cash machine funding moonshot projects like artificial intelligence advancements and quantum computing research while still delivering consistent profits quarter after quarter from its core businesses like Google Search and YouTube ads revenue streams alone. Of course, no investment comes without risks. Even Alphabet could face slower growth ahead if regulatory pressures intensify. But right now, it looks like one of Silicon Valley's best bargains compared against peers trading at much higher multiples despite less predictable earnings potential long-term ahead. Whether we see a crash tomorrow or markets grind higher for years ahead, the strategy should remain consistent across cycles. Prepare yourself rather than trying too hard, predicting outcomes nobody truly knows beforehand anyway. Build cash reserves gradually over time rather than rushing decisions impulsively based upon short-term headlines alone. Focus on fundamentals underlying businesses instead of reacting emotionally to macroeconomic trends shaping broader landscapes globally. Let me leave you with 3 key takeaways from today's discussion. First, market crashes aren't disasters. They're opportunities for those who are prepared with cash reserves and patience. Second, while parts of the S&P look overpriced right now due to heavy reliance on tech giants like Tesla and Nvidia, there are still gems like Alphabet trading at attractive valuations if you know where to look. Third, and most important, your strategy matters more than predictions. Focus on resilience instead of timing. Drop a comment below, letting me know your thoughts. Do you think we're heading for a bubble burst or just some turbulence? Until next time, stay hungry, stay invested, and remember, bulls make money, bears make money, pigs get slaughtered.